afternoon. This is Adam Pincus of PincusCo Media. We're speaking today with a panel of real estate bankruptcy experts to help us understand what the next year might look like in the bankruptcy sector as the city absorbs the impacts of this pandemic. I'd like to introduce our panelists. It's David Schechtman, Senior Executive Managing Director at the brokerage Meridian Capital Group, Michael Fay, Principal Managing Director, Chairman of U.S. Capital Markets Executive Committee at the brokerage Avison Young, David Scharf, Chair and Co-Managing Partner at the law firm Morrison Cohen, Eli Tabak, Co-Founder and CEO at the owner and broker and financing firm, the Bluestone Group, and Richard Maltz, the CEO at Maltz Auctions. We're going to get right to the discussion, but if you have questions for our panelists, please feel free to use the Q&A button at the bottom of your screen to send them. We will be taking questions towards the end of this hour. Now, some expect a flood and some expect a trickle of bankruptcies. I'd like to start with David Scharf with this question. What does the litigation landscape in New York City look like as it relates to bankruptcy in the coming year? David?
Sure. So good to see everybody, and hope everyone is doing well. Thank you, Adam. Thank you for inviting all of us. I really believe that we're going to be in the trickle mode. A lot of the resolution, a lot of displacement that needs to be resolved is going to get resolved in the boardroom as opposed to the courtroom. I think the last place anybody's going to end up, and it's only if they're going to be forced to go there, is the bankruptcy court.
And why do you think it would be that way as opposed to sort of visions right now of an enormous flood?
Sure. So there are so many aspects of why a bankruptcy can be an efficient process. There are a couple of things that are particularly important to remember when you're dealing with the real estate world. Number one, bankruptcy is typically only a last resort. And the reason for that is because there are recourse carve-outs in almost every single loan that you're out there. It's a non-recourse loan, but if you file a bankruptcy, you're going to go on the hook for all of it. So that's a massive disincentive in the first instance. Number two, the efficiency of the bankruptcy process, which is something that is often utilized or viewed as a possibility. Right now, it's not that efficiency because there's no liquidity lending. There's no visibility as to what the future holds. And distressed sales is not where anyone wants to go right now because of the lack of visibility as to what the future holds for real estate or for real estate operating companies. Therefore, that incentivizes whoever is on whatever side of whatever transaction you're on to sit down and try to figure it out collaboratively and collectively, as opposed to spend your time and your effort in a process that probably won't get you a better outcome.
I might disagree a little bit about that, just to be on the safer side here. You know, we do workouts and business throughout the country, and we've seen a lot of issues on the tenant side from bankruptcies. We're going to see a lot of issues from borrowers who are uneducated and will still file with bankruptcies. In the last 37 years and all the workout business that I've done, you're right. The carve-outs do have a personal guarantee component, but it's still, you know, they believe that they need to do this from a legal standpoint. So a lot of the panel trustees I've spoken to through several district courts throughout the country, as well as a lot of the bankruptcy judges, they believe September, October, November will be a larger flood of those bankruptcies that are going to be coming in. We also know on the CMBS side, which is what you're really referring to about the bad boy carve-outs, which then accelerate the personal guarantees. We're going to see a lot of those still, as I said, a lot of these borrowers are $7 million to $25 million, and they're going to feel like they're backed up against the wall. Conversely, they're going to be giving back a lot of keys, is what we also believe. We're saying here, take the keys and be done, because we're not going to put more capital in for a long slog uphill. So anyway, I don't mean to disagree, but I had to, just because I think that's going to happen.
I will just say, I'm sorry, David.
David Schechtman, you're next.
We'll true up soon, David. But I think that both David and Michael are correct. It depends what you're dealing with. if you're dealing with a borrower that's somewhat sophisticated, not even that sophisticated, I think bankruptcy is really a last resort. Anybody will tell you that one of the first questions on any mortgage application or loan application is going to be, have you filed bankruptcy before? And frankly speaking, from a mortgagee perspective, in a litigious situation, we'd almost prefer to be in bankruptcy than the way state court is these days. And somebody would rather go to state court and go down that road almost for a couple of years and then use bankruptcy as a last resort. And there's no reason for them to go into bankruptcy now when they can use the slow court process that's available to us now in New York, or available to them now in New York, and then use bankruptcy as a last resort. So I really don't think somebody is jumping and filing bankruptcy before he files a state court action, or before he gets into a state court action. I don't see any reason why somebody would do that.
So
I would agree.
Adam, I'll take a little bit from everybody.
Sure.
I think the fundamental difference between this downturn, which is much more social issues and health issues, when you take 2008 and Bear Stearns collapsed in August, in the middle of August of 2008, by September, all of the portfolio lenders and then again, any regulated bank physically had regulators in the banks with highlighters circling and highlighting loans saying, you can't put out more money until you right the ship. You need to get these things off your books. When all of the people on this panel are on the phone with our contacts, we all are gray-haired folks except for Richard, who looks great. We're on the phone with all these lenders, and we're saying to them, here's XYZ loan that we're tracking. We know it because we sold it to you. David was the lawyer, and Ellie probably did mezz on it. We know that the ship is upside down. What's interesting this time is the lenders are saying, we agree with you. You don't have to be Einstein to tell me that my $20 million loan on a $28 million building, that I'm just barely above water, because we had three major factors affecting the market before Corona. One was the natural downturn from peak to peak. We had been going up, up, up for nearly 7 years. Two was the draconian and socialist legislation, which decimated free trade and certainly multifamily. And then the evolution of technology that hurt retail and parking. Then when you add Corona to it, I think everybody universally agrees values are down, so a lot of these loans are underwater. But the fascinating thing that I'm finding right now as I'm making my cold calls and reaching out, looking for product to sell and to value, is I have bankers saying to me, we agree with you. We have to sell these. But there's one problem, Schechtman. I don't have a regulator in sight. I'm going to forbear my pants off. I have the federal government giving me mixed signals about whether or not they're going to give us, the lenders, any relief. We know that the tenants have been given a reprieve if you're a residential renter. The commercial tenants are being given relief at the local and municipal levels. Comrade de Blasio and his folks on city council are looking to forbear everything. So I think what's going to be created, whether there's good guy clauses or not, and whether it triggers other obligations, I think that you're going to be inundated with bankruptcies, but not until the leaves change color. And go ahead, Mike.
No, really important. And this is one thing, just to add one quick point, was the CARES Act and the stimulus package is giving the regulators of the FDIC and the banks, not CMBS, not the other lenders, the forbearance options, and they do not have to classify and or write down those loans. Very, very important. I believe we're going to have probably one more extension of that. So what happens on the 181st day? They come back in and the borrower says, hey, I need 3 more months again. So what's going to happen is, what we're seeing is a lot of these banks right now are turning around and compiling all those loans that have been asked for those forbearances, and you're going to start to see some portfolio loan sales going on. So they don't have to turn around and start taking the write-downs and or the classifications, call it in 6 months from now. So that's where I think we start to see some of the nuances between CMBS, banks, life companies, and mezzanine lenders, and et cetera. So,
and actually, let me just go, before we follow up on that, I just want to ask Richard, where do you see things in the next 6 months, next year?
I mean, I substantially agree with Dave Schechtman. I think he hit the nail on the head. One of the other considerations that we see before we see bankruptcy assets to sell is it's usually filed on the eve of a foreclosure. Right now, there are no foreclosures. That in and to itself is going to delay the process at least 3 or 4 months.
And how after that, where, like, do you think, if with all the forbearance and stuff, could that extend for years, or could people start getting closer to paying
You're
off?
a combination. There's plenty of borrowers that are either aren't sophisticated enough or have chosen just to throw their hands up in the air. And there's going to be, in my opinion, 3 to 6 times the volume of bankruptcy asset sales as there's been in the last year, starting in maybe 4 to 6 months from now.
How does that
Instead of
compare
100 times like there could be?
compared to 2009 and 10? Is that like on par or more or less than that?
It's going to dwarf it. It's going to
Now.
dwarf it.
Once the floodgates open
Totally
up,
agree. Totally agree.
And Adam, the unfortunate circumstances is 2008 was largely engineered by us. It was credit driven. We created all kinds of, Ethan Penner-esque products, CDOs and CLOs and acronyms that to this day, sound like MSG and Chinese food to me. And all those things really created the credit crunch. The 4 factors that I articulated earlier, we've got a real issue. I don't think that there's a borrower or a lender who will disagree that values have fallen precipitously. It's not artificial. We have technology that has changed. A retail store on the Magnificent Mile, and Michael would know better, that's getting $300, $400, $500, $600, $700 a foot. You could be sitting there for 2 years. You can chop up the Old Navy into 35 different stores. It may take you 4 years to rent it, and you're going to see a net 50% of what you used to. This has nothing to do with good guy clauses. We are just going to see vacancies. I think that the first bankruptcies that you're going to see also are going to be businesses where the real estate is ancillary or it's surplus corporate real estate. For Pete's sake, you're talking about Neiman, you're talking about JCPenney, but you're also going to be talking about food chains, Potbelly. I hope they never go under. Their stuff's kosher, I promise, Ellie. But you're going to see bankruptcies happening 100 miles an hour. The issue is how long until we get to an auction. So I'm very active in the southern and eastern districts of New York, and have the good fortune of having handled 71 363 sales. I had to plug myself, I'm sorry, over the past 15 years as a broker and 6 previously as a lawyer. And look at that tie. I was on the phone with a federal bankruptcy judge in one of these Zoom calls with my mouth shut, and he essentially said to me, look, the bankruptcy code has, it was written as a safe haven for people. And it's oftentimes from beginning to end, from notice of default to a bankruptcy auction, is generally 2 years. I'll bet all of our listeners a nickel that you're looking at 3 years. You default somebody today on a retail strip in Lower Manhattan, you're not going to get to an auction for 36 months, which is actually going to make the loan sale a more attractive option.
Right.
David,
Can I pick up on that?
yeah.
I think it's really important to maybe tie some of these ideas together, because I agree with David in terms of as it relates to timing. And I just want to pick up on what Ellie said. The concept of the timing of the filing for a real estate entity, that's not an operating business, because we really need to separate out operating businesses that had real estate as a component of their asset base, which may have been in trouble before COVID-19 hit. But for real estate assets that are just real estate assets that's what they are. They generate income. There's debt service that's due on them. There's a lender out there. The way you need to think about that is there's going to be a notice of default. But before you get there, you're looking at a 3 to 6 month forbearance period of time. And then things are going to start spiraling downhill, because the biggest problem that I think has been in the marketplace for the last couple of years is the fact that low cost of capital has not forced the market to reprice. Prices have been very high, but nobody's been taking back properties. There hasn't been a lot of trading going on because you can just keep the property afloat for a long time for very little money. Now that you've had a cataclysmic economic event, it's forcing the repricing. It's going to require people to look at value at 50 to 70% of where it was 3 months ago. And that repricing, because of the timing that's involved, 3 to 6 month forbearance, 2-year state court foreclosure, 3-year bankruptcy 363 process that gets tagged on after that. That's why I come back to, that's why this is going to get resolved by people buying and selling loans. Schechtman is going to be busy like nobody else's business. Michael is going to be helping people who are sophisticated, who are going to be saying, here, there's a path that you need to take that is different than the foreclosure, that's different than the bankruptcy. You've got to figure out, is there white knight capital that's out there? Do you want to give the keys back? How do you want to operate?
So once, I mean, since I want to talk here about bankruptcy, how will the process be different right now? There's a couple of things that are not even happening, like the foreclosures are not happening. What are other steps along sort of the classic bankruptcy process that that are not happening right now?
So I think there are two problems with, and there's been a lot of preparation. I'll turn it back to Michael because he can talk about it probably best than all of us. But as a matter of process, you know, once a company files and goes in and there's a plan for reorganization concept, there's a need for debtor in possession financing. And right now, that cost is either very, very high or not available. So that becomes a deterrent to an immediate filing. The next part that would typically happen in the 363 process is a marketing process. Board of directors need to make decisions about what offers to take. Prospective purchasers need to go out and kick the tires. Those have all been affected by social distancing. Those concepts of typically going in, looking at assets, doing due diligence, getting your environmental reports done, looking at, you know, if you're dealing with a portfolio of properties, looking at multiple properties around the country, getting on a plane, all those things that we took for granted that made the process seamless and ultimately transparent and somewhat more efficient than a state court foreclosure. There are all these new barriers that are now in place because of COVID-19. And that's going to have a profound impact on whether or not it's a smart option, but it's also going to change the process and the way people think about it.
So to pile back on what David was saying, and it's a good situation. You know, really everybody has to realize people, if they don't believe there's an end in sight, they're going to go to bankruptcy quicker. But, you know, normally you'll have to go through a state court proceedings to go through there to get in and do what you got to do, unless there's a cool down period. Some loan provisions have cool down periods where you've got to go through that first before you then can enter into the courts. And you're right. On the last days, that's when people tend to file bankruptcy. So, you know,
just to ask, what types of loans tend to have the cool down period? Is that any?
It depends. A lot of, you know, I think Ellie will know that a lot of the mezz equity groups have cool down periods. They trigger buy-sell agreements. They trigger other capital that come in, white knight capital. They have a lot of things that they can try. And then we've normally seen when that is failing, literally on the night of, going to either the foreclosure or filing in the new courts, they will file bankruptcy. And then that starts the clock all over again. So we tend to see a lot of those different things. And you know, all of us are talking about different situations. Even if you go to a note sale, you sell the note, you sell the box of papers with a lawsuit attached to it possibly, and then you're going to find a way to either get to the real estate and or work through the issues. The buyer of the note has got to continue the whole process. So it doesn't shirk anybody's responsibility. It gives it to somebody else. And that's why banks a lot of times don't want to spend the money on the foreclosure process. They don't want to have to identify the loans and then go ahead and reserve against the loans. There's all sorts of, you know, other expounding and compounding issues that go through this. So for all of us on this phone here or on this panel, we all see different areas. And, you know, from Richard and Ellie and all of us, we all have a different touch point on this. And to some degrees, it's bigger or worse. we're doing all the work for Sears Corporate right now. They've already gone through their bankruptcy, and we're liquidating and selling off assets for Sears. It's because it's heavy real estate, which is great real estate, which then helps the old Chapter 11 and recapitalizing on that. So there's different plans. So you're going to see stuff in the beginning, stuff in the middle, under 363 sales or reorganizations, which that's a whole nother key, and or outright selling it again for the foreclosure.
Eli, I'd like to ask of like the different kinds of properties that might, different kinds of business structures that would go into. Would you be looking at like ongoing businesses versus just single assets?
So let me just to pick up on the conversation that we were having now and maybe go into this. I think this trend that we're going to start seeing, and I think everyone on this conference will agree that we're going to start seeing a big uptick in loan sales, and that's where things are heading. And the reason for that is, and I don't have to tell that to anyone on this panel, banks are not in the real estate business, they're in the lending business. And most people on the note purchase side are in the real estate business. The last thing a bank wants to do is own a 6-story walk up in the Bronx with 40 apartments and have HPD calling them in the middle of the night. The investor sees this as alternative investment into real estate. And that comes along obviously with a lot of hair on it, and that's why they're coming in at a discount compared to the market value of it. So what you're going to be seeing over here is people that are ordinarily out in the marketplace buying real estate are going to be shifting their focus to look at buying these assets, these loan assets, as a way to get to the real estate. Now, depending on what that investor's appetite is in terms of what kind of real estate he likes to buy, though, that's the area of note purchases that he's going to look at. But in terms of what's going to be available, I think the first thing that you're going to see available, and conversely, the first thing that people are not going to want to look at, even in a default and an opportunistic scenario, is the hospitality market. I mean, I don't see that coming back to where it was 5 months ago, quite frankly, for another couple of years. And I think that's where you're going to see the first crack on the loan sales side.
Adam, I think in terms of where your starting proposition is, where you're going to see action besides in the trading of the notes, whether it's in the CMBS, but people are what I call trading down the cap stack to try to get into that controlling note holder position. There's going to be a lot of action as it relates to the mezz loans. And, I think that's something that Eli can talk to, because the mezz loans can be the real catalyst for action and activity that will see its way earliest into the courtrooms. When you're going to get the UCC notice that there's going to be a UCC foreclosure sale, somebody's got to react. And the reaction is either going to be, we're going to court to get an injunction, or there's going to be that bankruptcy filing. And that's going to be where the early action is. That's going to be visible to everyone to say, where's the activity? Where's the distress happening?
Yeah, I agree completely. And as David would know, most of these mezz loans, there are intercreditor agreements between themselves and the senior lender. They don't want to be in a situation where the senior lender is in default, accruing at a default rate, and these mezz lender is in the back of the bus behind a huge default rate. Most of these intercreditor agreements have a standstill period that allows the mezz lender to acquire the senior debt and be in a better position. And I think a lot of the loan sale transactions that you're going to see are trades, unless the mezz lender is completely out of the money. But if the mezz lender is still in the money, they're going to be moving to purchase the senior loans.
And I think, Adam, that's an important point. You're going to UCC sales. So when
Absolutely.
when there's a pledge of the membership interest. So very often for the couple hundred people who are listening, many of them know you have equity at the top, and then you have the senior secured first mortgage. And then there's usually, if it's a larger deal, although it comes with an intercreditor, there's usually another level of debt or preferred equity. And those people, their remedy is through a uniform commercial code foreclosure, which is a much speedier process. In markets that are flat or only slightly descending, or that are driven more by credit and not a complete collapse of value, like 2008 through 2011, you were seeing a ton of UCC sales because guys like Eli would say, I'm happy to have a senior secured first mortgage with Joe Fingerman at signature. It's a great rate. It's still 3 3/8, and I've got 4 years of term. This time, those mezzanine lenders are going to say, oh boy, I'm wiped out, but do I want to foreclose because I have a $30 million loan with signature? The asset's only worth 26 this time. So I think you'll see UCC sales, but I still think bankruptcy is the best route. And one last distinction, when we talk about bankruptcies, very often folks like Richard and Michael get involved with bankruptcies that are not real estate driven at their core. For instance, there are companies that go under and the real estate is not the driver of the value. They may have been other operating businesses and the real estate is certainly valuable. I think what you see, and those will take longer these days, but I think what you're going to see first when you file a bankruptcy and there's a cover sheet, you physically check off, hey, this is an SARE, a single asset real estate filing, meaning it's one building, one asset. Those are going to go quicker once the note trades.
And where do you, in terms of picking up properties that have gone into bankruptcy, this is looking down a year or 2 years down the line or whatever, but the bankruptcy that's an ongoing concern, like a grocery store, and then picking up leases and stuff like that, where is anything different now with?
Yes. You can accept, and I'm the wrong person to speak to this. I only played a bankruptcy lawyer for a few brief years. We have David Scharf here, but there is a provision that allows the debtor to accept or reject. Let's say it is a grocery store with 30 leases. Very often they'll accept or reject them. So there is a big problem is going to happen in the city with a major retailer on a high street. I think it's Fifth Avenue. And this retailer who is about to file has already signaled to its creditors, we're going to reject all these other leases, but we're going to keep this Fifth Avenue lease because we know it has tremendous value. I think the more complicated bankruptcies, like David said, are still going to be a last resort. And you'll be reading about bankruptcies that have on the index that have a 2020 filing. You won't see an auction for 3 to 4 years. The single asset real estates will get resolved much quicker.
So, and one of the reasons for that is by statute, and a single asset real estate process by statute is required to be resolved by the bankruptcy court quicker than the operating businesses that David was talking about, where real estate is part of the value, but isn't the only asset of the business.
Richard, do you all handle that kind of those kinds of assets as well? Is for a non-real estate business, some companies just trying to get rid of all their leases, or do you handle that, or properties?
Absolutely. So the vast majority of our sales are real estate sales. However, there's plenty of entities that file bankruptcy with personal property, intellectual property that needs to be sold. It's part of the bundle of services that we provide to the bankruptcy trustees and the Chapter 11 debtors. We sell everything.
And is anything different this time around, do you think, as the way that you're preparing for what might be coming?
I'm preparing for an onslaught of inventory. I think the first thing to file are going to be the small mom and pop retailers, as well as some of the larger retailers. I think I'm going to be changing locks on 5 locations a day, if not more. And kind of to one of the other panelists' point, from that, you're going to have some of these entities that file that own the real estate as well. And maybe it isn't in a separate LLC, or they haven't been paying rent properly, and the trustee is going to find a way to bring these assets into the sale which is going to result in additional real estate sales.
Mhm. The
It's just going to be an interesting time. I mean, I think that the one thing that I think David mentioned earlier, Schechtman, was this is something that is a big science experiment and social studies experiment for all of us. And I think that it's going to be far-reaching, where a lot of things could resolve themselves very quickly, and some things are going to go on for a long time. And it may take where, you know, in 2007, 8, you know, we saw the downturn. It was slowly coming, then it ramped up. And then it took, you know, a whole year of 2009 where everybody was kind of like pencils down. I think we're going to see more people. There's more capital in this market today than we've had. I think lenders, there's a lot of dip financing right now. We're getting phone calls for the dip financing already, but there's lenders out there that are ready to lend as soon as they get to understand the risk texture in the marketplace. And that is the hardest part today. We're seeing land deals trading a little easier because you can price in risk 2 years out, 3 years out. You know, how do you price in risk on a retail deal or an office deal right now where you don't even know which tenants are paying? One thing I do want to mention, and I think that a lot of people on the call have been asking, we do a lot of work with the CMBS side and the special servicers, and did probably 2,700 deals in the last 10, 11 years during that time. And we saw right now, hospitality is the number one. There's billions of dollars coming into special servicing right now. I mean, pre-COVID, there was probably, I don't know, 70, 60 loans in special servicing and hospitality. In the last 2 weeks, it's up to 509. So you think about how many of those properties have come in. And again, I'm talking US. You then are seeing the retail. There's billions of dollars of retail coming into special servicing. And then you look at student housing, a little bit of multifamily. You're looking at office next. And then last on the line is industrial. And the industrial side, if you've got manufacturing issues, that's where you're seeing some of that. So I wanted to throw that into the mix of all this.
And Eli, I wanted to ask, I mean, or maybe this is for someone else, but if someone wanted to get into the process, if there was somebody who was wanted to be a dip lender or something, like how do you even, are you allowed to talk to the debtor in possession, or their attorneys? Are there regulations about who you can talk to?
I think that's, I mean, I could talk about it, but I think that's really a question to David as to who could talk to who, because that's an interesting topic. Actually.
Everyone should go to Michael.
Well, David, you want to talk? Like, are there any?
No, sure. Listen, if people have capital and they want to deploy capital, the most important people they ought to be talking to, and I said it tongue in cheek, but let me expand on it. You talk to the advisors. You talk to the people that are out there who are dealing with the distressed borrowers. They're the ones that need to figure out where their capital sources are coming from. So raising your hand and going to the likes of Michael and saying, listen, I want to deploy capital into distressed markets, whether it's operating companies, whether it's real estate. I want to be a white knight. I want to make myself available. You know, Eli plays in that world. Schechtman is involved in brokering those deals. You know, talking to all these people and getting your foot, if you're a novice and somehow you've got a bunch of capital behind you looking to be deployed, you're looking at a lot of people on your screen right now that can help source your money into the right funnel.
But are you allowed to? Can someone just call the judge up, or like what are the rules?
So you don't call the judge. It's not the judge's job. It's not the U.S. trustee's job. It's the lawyer for the debtor or the prospective debtor. It's the advisors to the prospective debtors, that they're the ones that are the best people to be talking to.
But they get
or the lawyers for the lenders, or the lenders to talk to them about buying their positions.
So all of that that's all. I'm just like, there's no ethical, legal. You're allowed to call all those people.
Of course you're allowed.
The legal problem is for the debtor in post-petition to be communicating directly with the creditor.
But okay, but someone else other than that can come in and say, I'd like to help you, give you
Sure.
$50 million to,
Adam,
Absolutely.
it's the hallmark of free capitalist society, and you know, it's you've got the capital, you want to jump in there, you've got to find the place where to deploy it, you've got to find the avenue, and you're looking at a lot of people who have the avenues right now.
It's going to be creative.
Yeah, Adam, I think what you're asking for the several hundred people, 392 people who are listening besides the panelists is, if I'm a neophyte or somebody who has capital, who do I call? I want to buy some of this stuff. Values are down and I want to hold it for 10 years. I want to get rich. Let's say what you really want to say. How do I get involved? It's relationship driven. I was a neophyte 12 years ago, making these calls in 2008, and you get a little thread and you keep pulling and pulling. But don't make cold calls to banks. You know, and that's not to dissuade people from doing it. You're really going to wind up with a whole lot of nothing. You have to have been, everybody on this call has been in the bankruptcy and workout and turnaround world, or whatever, whatever the vernacular is. We've been in these markets in good times and in bad. And I don't think there's a person on this line. You know, Maltz Auctions has been operating in up markets. The bankruptcies oftentimes are caused by death, divorce, a change of business circumstances. So if you were to just pick up the phone today and cold call Citibank and say, I want to take a look at your list of loans, I don't think that's happening this time.
Right, exactly. You know, Avison Young, we have our whole asset resolution team, which we created over 10 years ago. And we've got professionals across the whole country that are looking at all these issues for the banks, for the special servicers and other mezz lenders that we're helping with BOVs. We're helping on other assets. We're doing a lot of that work. And then, of course, we enjoy a great relationship in the federal courts, also in the state courts in and around the whole country, to where we end up getting involved in this. You know, you're going to see a lot of the groups that are going to be doing these large loan sales portfolios. You're going to see other groups that are going to be doing individual loan sales where they're going to peel out certain assets and know that there's a real piece of real estate attached to this box of papers with a lawsuit attached to it. So as David was saying, you know, there's going to be a lot of ways to look at this, and there's going to be a lot of money that's going to be looking these different ways. And there's going to be a lot of creativity this time, I think, to help, because we're in certain times that we all have not seen before, but there's a lot of the common denominator on the bottom, which is it's going to get resolved some way.
But
Right.
David,
the other thing we didn't talk about,
well, I just want to ask,
that's going to be a large driver for loan sales, is all these debt funds that put out money that are having huge liquidity issues now as a result of the fact that they're leveraged their positions with CLOs or other facilities that are tightening and calling margins and stuff like that. And you're going to see a lot of the debt funds close up shop or have to raise capital to secure their positions. And you're going to see a lot of those type of sales that are not so much driven by the particular situation in that asset. It could even be performing loans that are being sold for them to be able to raise capital. And we're starting to see a lot of that, actually.
in New York, there are people offering to sell those.
In all markets, it's not people, it's funds
In the fund.
that are using some of these sophisticated facilities to be able to secure, to be able to leverage their positions, and those positions are being called now.
David, I just want to ask a question on the idea that you've been in this, doing it for 12 years or whatever, and people should not be calling the banks up. Wouldn't the banks have some kind of fiduciary to have to listen to anyone who might want to call up? I mean, obviously not, you know.
Boy, once an investigative journalist, always an investigative journalist. How do I get everybody in there? Sure, Adam, they have a fiduciary, but let's say I'm and let's really take off the pretense. I'm a 55-year-old workout specialist. I've seen several cycles, and I work for a portfolio lender, XYZ Bank, that has commercials, and you have their credit cards, but we know they've made a lot of real estate loans. And boy, I want to pick off a lot of their loans in between 5 and 15 million, because that's what my friends and I have done. And we're going to buy some of these notes, and 10 years from now, we're going to be wealthy. So I'm going to start calling up the bank. Where do you start if you're a neophyte? You start with a 1-800 number and ask for the workout group. Guess what that group's going to give you? It is going to give you a list of loans that are for sale, but each one of those loans, or I'd say 99% of them, it's going to say next to it, Meridian Investment Sales, Avison and Young. I don't know of any other firms, but it'll say there will be a broker attached to it. So when I wanted to, with my principal hat on, buy a strip mall in South Jersey that was in bankruptcy in 2011, a couple of us cobbled together money. We had to go through CBRE, who was the appointed broker handling that. Banks fulfill their fiduciaries by engaging people who deal in goods of the kind. You're not going to have that lender running a process themselves because they don't have one or two. They've got a lot of them.
Mm-hmm.
They have to show things are widely marketed. And I'm not sitting here saying that they're not going to do some one-off deals, because they will. But the point is, and David's right, they're going to have to show it's widely marketed to take whatever loss they're going to do to be able to justify to shareholders, bondholders, whatever they're going to do. So they've got to watch through that. You know, that is the fiduciary. That is truly the fiduciary of what that is. So, you know, and the other part is this: you have to remember something. In selling notes, it is very, very a lot of confidential, financial information. You've got to be careful of banking laws, who sees it, who doesn't see it. And the banks have got to be very careful. They just can't just say, oh, by the way, here's a loan. They can be set up under their own issues of disclosing financials or certain things that, can be detrimental to them.
And to the neophyte, Adam, the point that Michael made about the one-offs, those one-offs typically happen and they're relationship driven. So it's really hard for the neophyte to be, and that's why I think David Schechtman was saying, don't expect to be successful if you're going to reach out the bank, because the bank that does the one-off is doing the one-off on a relationship basis with people that they have dealt with, people that they trust, people that they have non-circumvent and NDA agreements in place, that they have that history of trust, that they're not worried about disclosure and all types of other issues that they might otherwise have with somebody off the street.
And to add to that point, you have to remember, when a bank is making a loan, they're in essence giving a thumbs up to a borrower. They expect them not to be nefarious, and they're partners in essence. And they're saying, we believe in you, we're going to give you this money, let's get into this together. For whatever reason, if they have to sell that loan, you're talking about a loan file, to Michael's point, that may include personal net worth statements, social security numbers. It's not as simple as it may seem. Even for a $4 million loan on a tiny building in Red Hook, there's a lot of sensitive data. So when they run these processes, oftentimes, a bank, a portfolio lender in particular, may call up another borrower who they know deals in goods of the kind and say, hey, we've got a borrower. He's candidly done almost everything right, but the world's collapsed around him. He doesn't have any more money to pay. A lot of these loans are sold in what we call a desk-to-desk transaction. I didn't go to a good enough college to be in private equity. So, but all the private equity guys, they'll call each other up, and folks as adept as Eli Tabak, he's getting phone calls from the portfolio lenders now, and he'll say, I'll take number 1, 3, 5, and 7, circle it. They sign and close. These loans do not come with soft periods. And by the way, I'm being provincial. Michael is national and Meridian is national, but my loan sale business, and so is Richard, my loan sale business is really within 100 miles of New York. Even in a down market, it's 10% down, close inside of 30 days. Diligence is whatever file we have, and go and do it on your own. They're not easy things to buy.
So a related question, but how does someone get into the business of being chosen by the receiver or the trustee once bankruptcy, in 2 years, whenever that happens? How do brokers get some of that business?
Maltz Auctions has been in business for how many years?
Going on 40.
40 years.
Well, that's one way.
Well,
The other way.
it's a real way, and there's a reason why they're still in business. Avison and Young has 40 cajillion offices. Meridian did 40 billion in mortgages last year, and we're entering into our 35th year. I'm a licensed attorney, and even in Up markets, I'm in the courts. So the answer is, it is a very tightly knit club, not to exclude people, but to run a process. Once a broker or other professionals are engaged, believe me, we go as broad as possible, or as broad as we're told by our clients. We're essentially the quarterbacks and they're the general managers. So if some of your viewers are saying, I want to buy a loan, I'm a brain surgeon, and 6 of my friends got together. We've got a lawyer in the group and a real estate guy in the group, and we've got $20 million of cash. We want to buy these loans. Get on the phone with the auctioneers, get different counsel. One of the major pitfalls that I see are very accomplished real estate people who historically have not played in this sandbox. They continue to use their transactional counsel. And very often you can have transactional counsel that are solo practitioners or 5 or 6 person real estate lawyers. They'll do $100 million deals and they'll do it very well. But when it comes to this sandbox, if they don't have the suite of services that somebody like Morrison and Cohen has, tax, litigation, real estate, finance, and bankruptcy, if they don't have those expertise, even with money, you may not be able to get it. So get a good broker to bring you opportunities, get a good lawyer who has seen this movie before, preferably a guy or gal with gray hair, because this is not for the weak of heart. It really isn't.
So, okay, I'd like to throw in some of these questions from some of the listeners. So these would be kind of round robin. This is from Lewis. How do you see the bankruptcy question as related to multi-residential buildings versus commercial buildings?
It's the same. It's the same in some ways, except for there's going to be judicial areas. New York is going to be different in some ways because of certain restrictions and or citywide laws. So you're going to see some of that in certain areas. It's also going to depend if it's workforce housing, Section 8. I mean, there's certain things that you're going to end up having to deal with. But effectively, it's the same. Or if it's bond related, you know.
Okay, and this is a question about special servicers, sort of asking why. Is the benefit for special servicers holding these distressed assets solely to take more fees? Where do they usually take their fees? I remember buying special servicers. S.L. Green bought special servicers to get an inside track to their assets. Isn't that one reason?
So, Laurie, let me, I'll handle this in a minute or less. First of all, under CMBS 3.0, there are, you have to hire third-party, non-affiliated groups to handle the assets. That's number one. So that is a big thing. The servicers themselves, remember, there's the B piece, the first loss piece, which is known as the controlling class representative. L&R, Rialto, a lot of those buy those C3. They will buy up and down the capital stack to maintain that controlling class representative piece. So that way they can hold and maintain the servicing piece. Now, to answer your question, is they come up with groups like ourselves and other brokerage firms with plans. We do a BOV. We look at where the asset sits. What does it look like? I mean, there's a long plan. They can hold these up to about 3 years, to be honest with you. Sometimes they'll say, no, we're just going to sell it and be done and just in and out. But they normally look to, take the property through the foreclosure process and own it. There are fees that come across the whole thing. I mean, so I wouldn't say they hold it longer for the fees. They're doing it because they're also controlling the bond piece and also trying to do the best for the bondholders, which also goes back to David Schechtman's point. There's a fiduciary there to the bondholders. And, you've got the credit rating agencies that are going on. So you've got to fulfill those duties to the bondholders. So it goes on. And they're dealing in the CMBS world is totally different than dealing with the banks. Banks are much easier at the end of the day because of, they're making their own decisions a little easier.
Michael, I'm curious if you've seen that so far in the COVID-19, and this has been my experience so far, I have found the special servicers and the master servicers actually easier to deal with, more receptive, more responsive than they were in 2009 to 2011.
So I'll give you one bit of information. The servicers in the first 3 weeks of the COVID issue were receiving default calls or forbearance calls every 90 seconds. So the master servicer is the one who's receiving that with the special servicer. So yes, there's much more communication going on really what to do because it's an onslaught. And you have to remember, it will get transferred to special servicing within a 30-day period of either a monetary, non-monetary default or an imminent default. And when you're telling them you're not going to pay, there's imminent default. So that kind of triggers that. So yes, I would agree. There's been more conversation, but again, it's a process. You know, you can skip around a little bit, but you're not going to skip right to from taking it. You know, oh, it's in servicing. Oh, sale. It just doesn't happen that way.
And
There's another aspect to it that I think answers the observation that David Scharf was just saying, and that is, besides for the fact that the special services like to collect fees, and we all know that, and just to understand what the concept of a special servicer is, you probably need a 20-hour conference like this to even know what we're talking about. But they have their fiduciary to the bondholders is very, very, is always hanging over them. So, being in a circumstance like we are now, like we've never been in recent history at least, gives them a lot more flexibility in being able to make a decision and not be exposed to litigation later on, I think.
Eli, actually, someone sent a question for you. It says the challenge before, it's not exactly a bankruptcy question, but sort of as it all wraps up, the challenge before COVID for assets and the new regulations that they kept coming out with, the rent freeze, the stabilization. So there was that challenge. So buying distress in combination with those regulations, how do you take that into consideration? Sort of the
Well, it's buying a loan is no different than underwriting a piece of real estate, because ultimately that's what your collateral is. And David Schechtman will tell you, we started seeing loan sales before COVID, just as a result of the infamous regulation that came out on the multifamily side. And when we, before all this happened, as the other panelists will tell you, selling a loan for less than par in New York City almost didn't exist. That started to change when, properties that were, loans that were secured by assets that had a lot of exposure as a result of the new regulation, and lenders wanted to, were trying to get rid of those. Those conversations changed a lot, because ultimately you're looking at the underlying collateral as your security.
That's right. So when you're buying a loan, you still have to be comfortable. Hey, I'm going to step in the shoes, and I'm probably going to get the keys. One major piece of underwriting that's different, though, from underwriting the real estate, you better underwrite the legal. And as David will tell you, and I oftentimes listen to my wife, who's a securities lawyer, when she's explaining to clients and oftentimes private equity firms, hey, here's a litigation budget, but you might as well take it and rip it up. I've seen this, and David's done umpteen litigations. You could rip up this budget because it can go any number of ways. You don't know who's on the other side litigating against you. And just because there's a good guy clause, or it may trigger other default covenants for an owner or a borrower or a debtor, that litigation could really erode all of your profits. So again, to my point, you can't have, and not to throw stones at them because they're a huge part of my business, that one-off storefront real estate lawyer should not be stepping into federal court and telling you, don't worry, this is going to take 6 months. You better really understand the risks. Litigation is the last place on earth. The only people who win in a litigation are the litigators.
Here's the thing, Adam. Either way I think about the budget that gets done, and we do them quite often in that short diligence period that our clients are out there buying loans. They'll come to us, okay, here's the loan portfolio. This is what it looks like. Here's the correspondence. Here are the docs. Map it out for us, because that's what we're asked to do, and that's part of our job. But the budget looks like an oak tree. And it's, if this happens, then you're going to go down this path. If you go down this path, you're going to be here. And you've got the bankruptcy, you've got the foreclosure, you've got the mandatory settlement conferences, you've got the summary judgment motions, you've got the appellate work, you've got the referee, you've got the lawyer. It just, it's an oak tree that branches out and gets bigger and bigger and bigger. And sometimes that's daunting. But most of our clients really like to get that because they know, and what it shows them is that we're thoughtful, and they can start putting some of that into a pro forma that they're trying to do. Just like Ellie said, it's about buying the asset. You have to underwrite it as you're underwriting the asset. You got to underwrite the legal. And that's part of the underwriting the legal, being able to map out what that huge oak tree looks like.
So here's another question. This is from Jacob. He said, beyond relationship building, can you talk about some of the data available to the panelists to identify distressed assets?
Sure. You know, when I got out of law school, 2000, we had LexisNexis and we had Westlaw, and it gave us tons of info. When I became a broker in 2006, I had Property Shark. I can't help but to sound like that old crotchety guy, because all the folks in the industry now, you have Reonomy, you have TREP, you have Bloomberg terminals, if you could mortgage your house and get a subscription. You have online newspapers. And in this day of instant media and instant information, so much, including property records and mortgages, are recorded. You could really do a lot of the research as a neophyte. It's incredible. I have buyers who have called me up and said, here's a clump of data and here's an address. And I'll look at them and say, wow, that's incredible. They'll say, now go get it for me, because I can't make this call. They're just going to say, oh, another rich guy who thinks he's a loan buyer. So the answer is, your viewers have a ton of publicly available information. We remember the days of mimeographs and Xerox, where there's a bank and there's a default. Now what do? Today it's, I could figure out every step of the process where to go. So those aforementioned places are where you do your research.
And another sort of broad question, where do you see the most opportunities today, in which asset classes? I guess just framing that towards bankruptcy, like which ones, you're saying hotel?
It's hotel and retail. That's it right now. I mean, hotel and retail are the ones that you're going to see the most. And I think in the next 6 months to 12 months, we'll see a little more texture from some of the other asset classes. You know, and again, some people have talked about student housing or assisted living or anything else. You know, there's a lot of speculation out there. What is the other one? But I would say right now, definitely hospitality, hotel, and definitely retail. And the retail is abounding from all sides, from the tenant side, the retailer side, the ownership side, you know, all those single assets, you know, whatever.
Adam, I would throw out to the panel for comment on what I'm about to say.
Mm-hmm.
I think condo projects that are more than 70% completed by now is going to, because there is not a lot of transparency in what the market looks like. That's another asset class that I think is ripe for investment for those that have capital, want to complete it, will rejigger the entire cap stack, bring down the basis, be able to reprice product which have to sell for $2,500 a square foot. And if they can bring that down and start selling it for $1,500 or $1,700 a square foot because they're able to discount their basis in a project, I think that's another area besides the retail and the hospitality.
I agree with David. It just so happens that on my desk, I have more of that. I have more partially complete, anywhere from, and I'm running a bankruptcy right now at 435 West 19th Street in Manhattan. It's we just did a cost to complete analysis, and obviously with the usual disclaimers, we think it's going to cost about $12 million to complete this project. It's a broken condominium project. I think that's the next one in, followed very closely by multifamily nationally.
So, well, here now it's 3 o'clock. I'd like to thank everyone for participating. Just to just to recap, it was David Schechtman, Michael Fay, David Scharf, Eli Tabak, and Richard Maltz. And next week, we're actually going to be having a panel on condominium development and sort of the distress there. So please join us in a week. And again, thank you very much for joining.
Thank you. It was great.
Take care.
Great panel.
Thank you.
Great guys.
Good luck, everybody. Stay
Take
healthy.
care, all.
Amen.
Be well.